Welcome back to Bull, Bear, and Brief. I'm your host, Joe Cortucci, with my co-host, Arpit Sharma, where every week we're going to bring you the best market commentary that we can, but only you can help us make it better. So you got to give us feedback and tell us how we can do it better. Arpit, we did it our first show last week. We're doing our second show this week. How do you think
Yeah.
we did? How do you think we did?
I think we did pretty good. I think there are some things that we could have improved on. I could have had a lot more information on hand, which I think we're going to do a lot better now. But I think the only thing I could have improved on was being more right on the market return for the week. I think I'm 0-1 right now.
Oh, and
We should have
one.
like
We
a
are going to keep track. Says I'm the old experience, 26 years under my belt in the business. Also, just a lowly old bachelor's degree, and you are the up and coming
yeah.
superstar who is a CFA. I am 1-0. You are 0-1, and let's see where this
Yep.
goes. I think after a year, we'll have a really good idea whether your brain or my instincts are better. Also, I didn't wear my Doc Holiday I'm in my prime shirt for that today because since I'm so much older than you, I figured I'd let everybody know I'm your Huckleberry. But yeah, I mean, the market had a real nice bounce back this week, is a little bit better than even I predicted.
hmm
Obviously, there was, just like we talked about last week, there was some tweeting and or truthing or whatever it's called, and some war's going to end, war's going to end, war's going to end. And then that speech came out Thursday after markets closed that basically said war's not going to end. And then we had a plane shot down. Actually, we had two
Yeah.
planes shot down and
Yeah.
some search and rescue missions, which I would say thankfully markets are not open for. I would imagine that would probably be a sign of escalation. Although I am not a military analyst, I can just say that I'd
That
be curious to see what's going to happen on Monday. What do you think?
I was gonna say if I had probably one more day, maybe we would have been tied.
Yeah, you would have needed to see a pretty damn big sell-off, and that's a good segue into how the markets performed last week. S&P up 3.4,
Yeah.
Nasdaq up 4.4, Dow
hmm
Jones up 3, and just so everybody is aware for the year, markets down about 4.1% year to date, which when you think
hmm
about it, isn't really that bad considering how much disruption the situation in Iran could potentially cause, and if oil prices maintain above $110 for very long, I think that's unlikely to be
Yeah.
sustained. But nonetheless, despite all the crap that's been going on, you're ending up with a market that's only down 4.1%. What are your thoughts on that?
I mean, they're showing a lot of still some level of strength overall in the marketplace. There's still a lot of pull towards, hey, the general underlying, apart from this random black swan event that occurred out of nowhere, the markets themselves are still pretty strong. Now, going into the course of the round war, we did have other stories, other narratives that were kind of shaking things up, adding some extra risk to the overall marketplace. But overall, there was still general strength, right?
Yeah.
I mean, you mentioned off the indices, large value or value stocks in general are still positive on the year, around 2.8 something percent. Now, growth, of course, took a little bit of a hit. They've had a great few years, and so this year has had a little bit of pullback. And then obviously the Iran war adding a little bit more drawdown to that. But overall, I mean, there's still a lot of strength, and the markets want this war to end so that they can then continue doing what they do best.
Yeah, no, they certainly have. I meant to tell you something when we started the show today. My wife tuned in obviously to the show, and she wanted me to tell you on the show that you are very very smart. I said,
Oh,
"What about
thank you,
me?" She goes, "You're smart too," but I tell you that all the time. So I meant to tell
thank
you
you.
that. But yeah, I mean, I think you make a good point. I guess I would kind of parse out. I'm not really sure. And again, I want to be clear, like we always do every week. This is not a recommendation. Nobody should
Yeah,
act on what we're talking about here. This is commentary, and this is kind of a back and forth dialogue between Arpit and I, where we kind of figure things out together in real time on the show. So please don't act on these things. But I do wonder if the market is fully priced in, I guess, the effects of heavily energy. I think long term, everybody, can safely
hmm
assume that markets will move up. But in the short term, 1 month, 3 months, 6 months, I feel like there's a lot of uncertainty. And again,
yeah,
I know it's easy to say you're bullish because the markets will go up, but here I think there's a lot of uncertainty and maybe not fully priced in the effects of elevated oil. We've now had elevated oil for about a month, over $90 for over a month, and really now way over 100. There are knock-on effects from that, right? That I think could potentially lead to economic calamity.
Yeah, and you can kind of start to see a little bit again, like because all this just still relatively recently happened, and it takes time for these rapid shocks to kind of make its way through the system. But one of the major ways, apart from just fueling your cars and fueling jets and everything else, oil is used in a variety of industrial uses, right? Plastics, for example, almost all that comes from oil. So one good indicator I guess you can start seeing of some level of impact is actually earlier this week is the ISM manufacturing, which is just an index where pretty much they kind of do like a survey and they and they try to they talk to major manufacturers, and they get a whole range of opinions and data from them, based on like backlog, confidence, and everything like that. And it was below 50, which is just showing that there's some level of contraction
in
or a
manufacturing.
reduction in manufacturing. Yeah.
Yeah.
And it's just now started. It's a slight dip, it's barely below 50, but when you start seeing that continuous decline, that's kind of the impact of high input costs. And that will make its way to the consumer
Right,
down the line.
eventually it will. It's probably a lagging effect. What about
Yeah.
natural gas? Has not shot up as much. It honestly kinda surprised me a little bit. Do you have any commentary on that?
Yeah, I mean, it
Because
is kind
natural
of.
gas is more drives the electricity prices. That's why I brought that up.
Yeah, yeah. And it is kind of surprising because considering that LNG infrastructure was struck in the Middle East, and you would expect some level of LNG. I guess over here in the States, natural gas prices itself haven't gone up too much because we don't really import much of that, right? We get most of it from the fracking industries over here in
We're
Texas
we're
and
heavily
the
supplied.
Permian Basin, right? I would imagine though that natural gas prices are pretty high in Europe, for example, or in Asia.
Yeah,
Right. So, and again, taking some time. There's a lot of factors impacting natural gas. We're also in the springtime right now, so gas prices. There's a little bit of wavy rises in winter, falls and down, and it goes rises again during summertime as electrical uses rise. So there's some level of effect that is just seasonality as well, but I would expect some level of impact eventually
yeah,
on
I would
natural
agree
gas
with that.
prices.
Well, let's talk about some of the big winners. Franklin Covey up 44% for the week. I had to look up what that company does, but apparently they're a large consulting firm, and the majority of their clients are big Fortune 500 financial services companies. Now, our
Yeah.
company's not a Fortune 500 company, but maybe we should look to hire old Franklin Covey. Just kidding. But they were up 44% on the week. Major earnings growth there. It might also be kind of an indication that people are trying to retrain their staff on artificial intelligence and how to use it more effectively and become more productive because we've seen over the past year a much more soft labor market, and so it might be that the big firms are looking to get more productivity and more training into their staff than hiring new people like they had been before. Is that a
Mhm.
fair assessment, or do you think that's way off?
I think, I mean, in terms of consulting itself, I see some level of efficiency gains across general white collar jobs, right? Uh, you can say that's probably a deflationary argument longer term,
Yeah,
right? But that's generally what we're seeing across the board. But that's also kind of what's also leading to a lot of the software guys and also some consulting guys take losses and some hits, right?
yeah.
Because you know, you don't need as many consultants. You don't need to pay the consultants as much. The job just became a heck of a lot easier, right? So yeah, I'm expecting some major disruptions built in these fields in the next few years
I would
as
think so. I
AI
would
just
think
continue to
I think
advance.
as people start to realize the power and the productivity boost that comes from AI. And I guess this is where I'll add my 47-year-old wisdom, which is with AI being something that's going to probably be here to stay. Not probably, it's here to stay. I would highly encourage anybody that listens to our show, whether you are older, whether you are younger, whether you are middle aged like me, make sure you are embracing this change and figuring out how to use it because it will keep you in a job or allow you to remain relevant because it's learning how to replace all of us. And so it's probably time to figure out, take a little class or do something to try to help yourself on that subject. A couple other big stocks, Kodak, which is always a
Yeah.
boom and bust cycle. It's kind of a, not for the faint-hearted, as they say. Spire Global, defense contractors, so not a real surprise there.
Hmm.
Another few defense contractors that did really well for the week. On the losers for the week, Estee Lauder, merger talks with a European company in Spain, but also just it's kind of this a good segue we'll get into here in just a minute as we talk about private credit. I think the market is kind of like now starting to seek out companies that have bad debt structures or structures that are
Yeah.
maybe a little bit more risky. One, I think, surprising facet of the war in Iran is that ever since it broke out, the dollar has strengthened and treasuries have actually sold off and interest rates have gone up about 30 or 40 basis points. So the borrowing costs, borrowing costs or corporate borrowing costs have actually risen. So if you've got a debt structure that the market deems as maybe a little bit risky, I think you're going to be facing some headwinds. And we saw that for sure in Estee Lauder. We'll talk a little bit about Paramount too. Paramount has got a heavy dose of people quitting. You can put me in that category. I quit Paramount, I no longer use them, and that's because I, have so many streaming services. I got to the point where it's like I'm not really watching it. I would also encourage all of our listeners to do that as well. Go pay attention to how many streaming services you have. I had two different versions of Paramount on two different forms, and I canceled them both. But Paramount got beat up this week as well. Any thoughts on any of those two stocks?
Not so much on Estee Lauder, Paramount. You also take into the fact that they just made a pretty sizable, I'm pretty sure, attempt to acquire Warner Brothers, right? $110 billion,
Yeah,
right?
that, I was going to ask
I think
about that. Yeah,
that's gonna apply probably a lot of debt to Paramount structure. Now, I mean, it's apparently his daddy's wallet because it's not so much the CEO of Paramount, but it's the CEO of
Larry
Oracle.
Ellingson.
Yeah,
He's one of the
a
richest
lot
men
of
in the
funding
world.
from there.
Net worth above $200 billion. If he loses 100 billion, I guess he still got 100 billion left.
Hmm.
I noticed on here that Super Microcomputer was down 11%. Their
Yep.
co-founder was indicted for smuggling chips to China. Yeah, not usually a good thing for your stock when your CEO or co-founder is indicted. It's not
I'm
necessarily a good thing, right?
I'm gonna say I don't think they're the only ones doing it. They're just the ones that got caught.
Yeah. Well, yeah. Well, I would hope that as we talked about AI already, I would hope that one of the innovations with AI would be detection of things like this, and that we could. In general, don't you agree that markets are pretty good at flushing out bad actors? And it's one of the things that I have a lot of hope for in the United States is that if you are openly corrupt or if you're openly have bad business practices, well, you may get away with it for 1 year or 5 years, but eventually the market's going to stuff it out and you're going to get caught. Is that a
Well,
fair
yeah, there's
assessment? I mean,
yeah,
you're the guy who does this, CFA. You know
yeah,
about efficient
there's
market theory, right?
a quote that in the short term, the markets are a voting system, but in the long term, eventually fundamentals prevail. Now, define long term, it's however long you want it to be, right? But ultimately, yeah, I mean, eventually major frauds do get pointed out, and the fundamentals just reach a point where they just can't be sustained,
Right.
right? Now, super micro in this case, it's more of a shock event. There's no 10K that you can read in the world or any report that could have brought that. So this is just black swan event for any super
Yeah.
micro investors. Maybe there would have been something, but there's nothing in any of the fundamentals that would have indicated that these guys are smuggling chips to China,
Right.
right? Um, but that's pretty much how it is. It's just like eventually, major news stories happen like there, and then major exposés occur, and it doesn't take very long for your stock to go down.
Yeah, I do often wrestle with that. Having been in the financial services business for a long time and been around some investments that have gone belly up or been in the vicinity of them, it is difficult to detect, and that's something that I wrestle with all the time. Is like you make a good idea, or you get a good idea, or you make a good investment, or what you think is a good investment. How can you detect those things? I think it goes back to the fundamentals, which is how is their debt structured? Is there a business model you can understand? Is their management team
Yeah.
vetted and smart? And they have a track record? And that does worry me a lot with some of these emerging AI companies and tech companies where, so much money was flowing around Silicon Valley that it was finding its way into probably some bad investments. And interest
Oh,
rates were so low
100%.
for so long that you probably got some masked crap out there, to use a really technical term. And so it does keep me up at night sometimes. If people want to know what keeps me up at night, that's the kind of stuff I worry about.
Yeah, I mean, I mean, we talked about this a while ago, and it's kind of out of date now. But that little tech circle of money, right?
Yes.
Where Nvidia would be investing in a data center provider who would then be invested also by OpenAI, who would then buy Nvidia chips. So it's just like this big circle of just everybody throwing the same dollars around. It's
Yeah.
kind of funny, right? But
Yeah.
that's just how it is sometimes.
That's one of those things that makes me afraid of musical chairs. I don't want to be the last one standing.
Yeah, exactly.
But that's what triggers panic selling, and we also know that panic selling long term is not usually the best thing to do. So
Yeah.
again, remember, we're not giving investment advice here. We're just giving our commentary. All right, best sectors. No surprise to everybody here. Energy off the
Hmm.
charts. And something that was one of your favorite ideas coming into last year and again this year, industrial companies. Healthcare is a defensive sector. We talked about that last week on the show. And then I said these exact words on the show last week: consumer defensive, right? So if you're paying more at the pump for for gasoline, and you want to go out to have Chick-fil-A, or you want to go out to have Olive Garden or whatever restaurant you eat at, if you are at the lower end of the pay scale, you're going to have to make different choices because more of your money is now going to fill up your gas tank. So really important thing there. So I was right about healthcare and consumer defensive. I would say that looking forward in the short term, that might be another place that continues to thrive. Any
Hmm.
thought on the big winners there? The losers were technology and financials. That's continued to put been under pressure. So, what do
Yeah.
you think about that as we move into the following week, the week of April 6th?
I think in terms of the more value focused sectors, so we're talking about like healthcare, industrials over there, utilities and staples. I think they're continue to be a pretty good spot to be in. The more concerning one is energy. Energy sectors. I don't like when these major spikes occur because then usually is followed by periods of major underperformance. So, but I'm a more long term investor. In the short term, I still think energy, healthcare, these sectors are still. I wouldn't see any reason in the short term to kind of move out of these positions. Honestly, if you already
Understood.
have them, right?
Yeah.
But personally, I kind of position for long term, and I think buying up if you're into the long term, you want to be looking into what's not up 30.
Where can you get value, right?
Yeah, where can you get value? And value, a lot of people associate value with just a fixed sector or a fixed price book value or something like that. And to me, that's just the wrong way of looking at it. To me, value is simply is something trading below what it's actually worth, and that can be anything,
Yeah.
right? You can as long as you can make a logical argument for it.
That makes a market. And I guess that leads us into a really good segue for the rest of the show, which is private credit. Is it at the point now where it's going to be a value play? Obviously, we've seen some serious destruction in the private credit space, and it's certainly something that is worth watching. What I'd love for you to do is help regular folks who don't understand the words private
Hmm.
credit understand what it is, understand what's going on there, and then maybe let's dive into that question of whether or not we're at a place where there is relative value to the private credit space, or if it's too just way too toxic to touch right now. Let's hear what you think.
Yeah. Well, on private credit, how much time do we have?
Well, we got
It's
about 13 minutes left, so get
it's a
you got as
it's
much
a
as you
big
want.
it's a big subject. I think it's worthy to
Try to
talk
make it
about.
try to make it very digestible for every man, though.
Yeah,
Think like an 8th grade level, because I mean, you and me we're geeks and we geek out on this stuff, but your average, teacher,
yeah.
firefighter, even
They
small
don't
business owner,
understand.
plumber, those people don't know what private credit is and why it affects them. So why don't you touch on that and give it kind of a
Yeah.
basic
So
definition?
so just big thing before you kind of in order to understand something, you just need to get a brief understanding of the history that happened with it. So private credit has existed for a while, right? It's essentially just whenever a company gives a loan to another company, and instead of that company issuing a public level bond, it's more so just a one-to-one transaction, and that's it. Basics of private credit. The private credit industry itself, as an investable class, blew up a lot post the Great Financial Crisis, and the reason is because these banks in the Great Financial Crisis, Citi, J.P. Morgan, Goldman Sachs, all these guys were heavily levered institutions, right? Because if you think about it, what is a bank? They take assets and they lend assets, and the money they make is just how much they can make on the assets, right? If they how much they can make on the interest rates of the loans. These banks were making a lot of money because they're essentially leveraging themselves up. And then when the great financial crisis happened, they stopped. And so there was a massive gap in lending that private credit companies like Blackstone, Ares, and Blue Owl kind of came in and filled the gap, right? And so you have this big industry that's been essentially shut off for most of the area to common investors. Only the ultra wealthy were ever even allowed to invest in this. And now, more recently, we've had the creation of these semi illiquid funds. And when we say semi illiquid, if I was to buy an ETF or a mutual fund, I can sell so long as the markets are open, right? I can sell it any day as long as the markets are open. Semi illiquid funds, you can only sell on a particular day, right? Either that's once a month or once a quarter. Usually these are quarterly, we call them quarterly redemptions because you can only sell them either at the beginning or at the end of the quarter. This invention of these semi-liquid funds started getting pushed out to less, ultra wealthy investors because they essentially were available to almost anybody. And now these private credit companies are massive, massive billion-dollar institutions. Now, one thing that also came out of the great financial crisis is that a lot of major hedge funds collapsed because they had these big bad loans and they got massively redeemed. Redeem is when an investor comes and says, "Hey, I want my money back." Because of the great financial crisis and because of all these mass redemptions, there's these things that just got created called gates. These are limitations on how much an investor or how much the entire pool can be pulled out at once. And this is something that all these funds institute. So they all institute 5% or 7.5% gates, which means that you can pull your money out. But if 5% of the fund gets requested to be pulled out in any quarter, we're done. We're capping it 5%, first come, first serve, right? Doesn't matter who's the largest client, who's the smallest client, it's just whoever gets it in first, the first orders, only 5% of the total fund can take it out. That's very important because that has been the main cause of concern. There hasn't been major deterioration or weakness in any of the bonds or the loans given out by these private credit managers. There's been a few hiccups. You guys may have seen it in the news. MFS, you had all the auto loan guys that kind of blew up there. Those are more, local once in a while, but they were big names,
One
and
off,
they're
not
kind of,
not not
yeah.
systemic.
It's not systemic. You're not seeing massive loans, massive deterioration yet.
Yeah.
Don't know
Well,
if you will, but you
could it
haven't
I was
seen
gonna
it yet.
say, could it become systemic? I think some of the fear is that, again, we're talking about AI again, it will probably be something we talk about every week.
Mhm.
AI is gonna disrupt some of these software companies that do make a lot of money, and there's software engineers that work there make a lot of money, and, the abilities that AI have could potentially displace those companies, and if they've got big debts out, then they go belly up. Is that kind of the fear?
That is the main fear, and the reason is that private credit works in tandem with private equity, and private equity is majority tech. Right? So
Right,
private credit follows the same thing. So around almost every single private credit loan, anywhere from 30 to 50% is tech. Right?
makes
Some of
sense.
them are almost entirely tech portfolios, right? Some major, issue funds out there are 100% tech focused. And so that is the cause of concern. And these guys don't the major tech companies are good. They don't need private credit.
Right.
Right?
No,
We're talking about
yeah,
like
they can do corporate bonds, right? If they
they
wanted,
they can they can sell it what they can do whatever they want,
and
right?
they're
They can
sitting
get
on
a two
piles and
percent
piles of
interest rate,
cash.
right? Their credit ratings are higher than that of the U.S. government, so they're good. But we're talking about these smaller software companies that really need these shorter term loans, and that's kind of where the major idea for risk is. Again, we haven't seen any major deteriorations. We haven't seen major losses there. There's a lot of other intricate details that are important and a lot of risk that's associated. But just get a gravity of the situation here. Just some of the major funds, Blackstone's BCred, $82 billion AUM, got hit with around a 7.9% redemption. Now they honored all of it, but that's a massive amount of redemption. The more concerning ones are Blue Owl's main income fund, which is OCIC, $36 billion, 21.9% redemption, and they have a 5% cap.
And
So
they
when
gated it.
people
They put it at 5%.
they gated it, and
They
that
have
and
to.
that causes panic. And so when you see, oh, your fund got gated, the idea is that it's just a continued capitulation. So the main risk here isn't that the loans are bad, is that there's so much redemption requests that eventually these guys are forced to sell.
Can they not, is my understanding though, that those funds can actually completely shut off redemptions in extreme circumstances. Is that not true?
It is true, but it will lead to massive lawsuits and mass panic across the entire industry.
It's interesting that there could be lawsuits there when it says it in the document that they are allowed to do it. So
It's a
it's
very
to protect investors. If anybody's ever seen that
yeah,
movie, The Big Short, Michael Berry's shorting the housing market and losing money like crazy, and some of his investors were trying to get out. And had they been successful in being able to get out, they would have not made the money that they made when it finally came to fruition. So
big note
that's
at
what
the
that's
end.
there for. I'm not saying it's right or wrong. I'm just
Yeah,
explaining how it
yeah.
works.
And big note at the end there, he still got sued.
Oh yeah, he did still get sued.
He still got sued.
Yeah,
And it would also entirely kill the industry if you
right.
start doing
It
that.
did. He
No
actually
matter how
exited that fund because of that. So
yeah,
no, it is a
yes,
good
it's
point.
a so they would
I,
not
I,
do
I
it.
guess it's a cautionary tale for investors. And again, remember, we're not making recommendations here. But if you have ever thought about buying one of these or you do own one, just remember that semi or partial liquidity does not mean full liquidity. And I think that's where there can be problems in this private credit space. One other thing that I wanted to touch on, and this is where your training comes in, and I really want to hear from you on this, which is
Mhm.
private credit is considered to be, I'm a CPWA and a CHFC,
Yeah.
considered to be lower risk, and the returns still tend to be between 9 and 11%. Like, you can
Mhm.
use any of the softwares that are out there that will rate the risk, but also too, like in general, it has one of the better risk return ratios of asset classes that are out there. But that doesn't mean it doesn't go through bad cycles. And when the bad cycles come along, historically, you've seen some real destruction wrought in that space. Touch on that a little bit. Like, is it misleading that they're lower risk, or is it, I mean, long term, or is it just because of the way they're priced?
Every private market, and this might be heresy to some, every private market investment, private equity, private debt, private real estate, when they start reporting risk numbers, it is misleading. It is not, it, and it's not like fraudulent misleading, right? It's technically true. They're
Yeah.
not lying about the numbers are technically true.
Yeah, you
It's
can't get away with
misleading.
that. You'll get put in, you
Yeah,
get not
it's
put in jail, but you'll
misleading.
get in trouble.
It's misleading in the way just math works, right?
Yeah.
They just don't report as often. If you don't report as often, your volatility is not as high, right? You don't have
And
as
most
much
of those
deviations in the price.
risk analyses are not really measuring the real risk. They're measuring how volatile they are.
Yeah, and so we actually do this in our own internal. We did this for private real estate, and when you actually take into account the smoothing, which is just how smooth and kind of lagging the data is, you take into account smoothing, you take into account leverage that's not reported on the returns. Private real estate across the board is more risky than a REIT, a public REIT of the same industry. This is seen across the board. The returns are somewhat the same, if not slightly lower, with higher volatility if you take into account true proper risk. So that's just something to consider. So private credit, and you were talking about semi-liquid. For me, semi-liquid is as good as not liquid. And I view it the same way because the only time it's truly, semi-liquid is in a roaring market or in an up market and nobody wants to redeem then. The only time you want to redeem is when markets are going down and that's when everybody wants to redeem and that's when you get hit by gates and there's no liquidity anymore. So it's a little bit like a misunderstanding of semi-liquid by most investors. When I view semi-liquid, it's entirely not liquid to me. That's how I view it. That's
So
how
is
I,
there
I
any
treat
in
it in
your mind,
portfolios.
is there ever any reason to do that? I mean, they certainly have higher yields, and if you're disciplined enough to exit while things are good and keep your
Mhm.
balances in order, is it ever okay to do that in your mind? I mean, think about,
Yeah.
50 and up clients, 55 and up, or not clients, but investors.
Well, so here, yeah, there is good reason to do it. And a lot of our models, or a lot of our, when we start doing portfolio analysis, true broad multi assets, right, where you could take into consideration private markets, everything like that. Despite, in the real estate example, despite higher volatility, our models always allocate something to private real estate. Now, the question is why, right? If you're expecting the same level of return but higher risk, what's the point? Right? That's just bad financial math, right? And the reasoning is that there's another component to risk, and it's just correlation, or pretty much just how assets move together, right? So how
Yeah,
2 points move together. And so these assets tend to be non-correlated. Again, correlation is also misleading in a way because again, they're not reported as often. They're
yeah,
smoothed out data, but still, there's still some level of decorrelation versus a public market equivalent. If I was to invest in a REIT in a down market, the REITs will still go down no matter what, even if it's maybe negatively correlated. Because in a down market, everything goes down. We saw this
right.
most recently:
Yeah, the
treasuries,
gravity.
gold,
Yeah,
silver, everything just went down. You still want that level of, we call it decorrelated return, right? And even though it deserves to be in most portfolios, now again, you have to fully understand and grasp that and take into consideration long term and your longer term goals. If you are more of a 70, 75, 80-year-old investor, I probably would not make that recommendation of getting into heavy private credit. I'll make the recommendation of being more liquid unless your point is to, I want to create a portfolio that's going to be passed down very long term returns, in which case, yeah, you would probably start adding some more illiquid strategies, and it can be used there.
yeah,
It's a case by case basis, and it's not without merit. Like there should be a reason to have it. It's just that this actually been a lot of recent stories and complaints. And it's like just people throwing private credit no matter what. You saw private credit and private equity getting thrown in 401ks now, right? Over there, like it's just understanding what the product is and what the structure of the individual product is, and understanding the asset class, and understanding that, hey, this is actually a lot riskier than that they say to be.
yeah. I think
But understanding that.
that's a good point, and I think this is where I'll make a comment. I mean, obviously,
Mhm.
I do I'm a financial professional for a living, so this is probably a little bit self-serving, but it's not meant to be, which is that maybe getting some help in this area is a good idea, and making sure you have the right balance of liquid and illiquid assets, and see where they make sense and where they don't. So that's kind of my attitude. And on the private credit story, I want to repeat something there that number one, right now, we're not seeing any systemic risk. We're not seeing gigantic spikes in defaults. What we are seeing is fear that that might be coming later, and therefore a large number of redemptions requests, which puts pressure on all these funds. And there has been a proliferation of fundraising in these funds. So that also, I think, is something that I get concerned about. Is are did they lower their underwriting standards? Do they look to deploy all this capital that they raised in a way that's not consistent with what they started out doing? And I think some of that is not the easiest thing in the world to detect for even really smart people. Would you say that's true?
Yeah, I'd say it's actually borderline almost impossible. And in private credit, It is truly impossible because the how they've done their lending is so opaque. You don't know what's in there, and that's another
But
source.
but you would agree that there are really great institutional funds that have great track records. We're not going to get any names here. You mentioned some earlier, but the reason why I don't want to say any names right now is I don't want anybody to rush out and buy them. That's not what the show is about. It's just
Yeah, yeah.
there are some really good names out there that have really tight institutional underwriting standards, and they usually don't ever kind of stray from them. Some of
The
those companies have massive, massive minimums, so they're not attracting the capital of the mass affluent. I mean, I'm playing the devil's advocate because if you
mhm.
look back at the last 20 years, private credit has performed extremely well, and so anybody who was disciplined to make sure that they didn't allow that to become out of whack is not really shouldn't be panicking. Right?
And this is here's the counter argument to that, right?
Yeah,
And this is
like I
not
said,
my.
we're working it out in real time, Arpit.
I know this is not my thesis. This is this is from another individual who's very intelligent in the financial field. I'm also another Big Short individual, Steve Eisman. He was played by his character was Mark Baum, right?
Okay,
So this guy
Steve Carell, right?
he Steve Carell, yeah, there you go. But Steve Eisman is his real name, and I recommend watching his YouTube videos. He was very intelligent in terms of financial space, and one thing he pointed out is that one thing he saw during the great financial crisis, he's actually seeing again today, and that is this feeling that this level of higher intelligence because you haven't experienced a major drawdown. So in the post in the great financial crisis, when he went out and talked to these mortgage backed security and these CDO fund managers, they thought because for the last 10 years, they've been making so much money that they're geniuses and they just won't make a mistake. For the last 17 years, there hasn't been a credit cycle in private credit. And there's been this big inflow of money. These guys are also thinking the same exact way. And so I wouldn't say, as we saw with the financial crisis, eventually, once you get all this money and this industry becomes big enough, you do start lending out bad.
Yeah, you lower
You
your
do start
standards.
making poor loans, and standards do get lowered. And again, this is much larger topic. Maybe we should have another a separate
We can
one for
touch on it
this.
again for sure next week. We're running out of
Yeah.
time today, and I want to make sure we leave enough time for our prediction. And before I get into our prediction, I do want to lay the ground rules. So you're bullish or you're bearish. That's
hmm
really it. If it's up, you win. If it's up and you say it's going to be up, you win. If it's down and you say it's going to be down, you win. Because we can both make the same prediction, we can both win. But if you make the
Yeah,
wrong prediction, it goes down as a loss. So I am 1-0 and you are 0-1. Is that fair?
that's fair. We should have like a little board in the back just tallying.
I know that's going to be your job. I know you're not in your normal spot today with your liquor cabinet in the back there, but next week when you're back in your room, I like the idea of a whiteboard being back behind you, and we'll continue to keep score. So I'm going to let you go first, or should I go first since I won last week?
We can do make it take it.
All right, I'll go make it take it. I am bearish for this upcoming week. Again, please do not take any advice from us based on this. This is really just more for entertainment purposes and for me to be able to have some bragging rights on ARPIT if I continue to win. But I think in this instance, given that this is really based off conjecture, the planes shot down. I mean, I am fearful of a large escalation, in Iran, and it seems like they have a little bit more capability than we even thought they did.
Yeah,
Conventionally, that's a conventional military win for them, shooting down one of our very sophisticated aircraft, and then following that up with shooting down one of our A-10s, which are the workhorses of our military. I think that has the potential to really kind of be problematic. Plus, you still have that pressure of elevated oil prices that really has not been worked in all the way to the inflation pictures yet, and what that means for the consumer-based economy we have here in the United States. So I'm predicting a red week.
hmm
I don't think it'll be a major red week, but all it has to be is point zero 0.01 red, and I'll get a W. So where are you headed with this week?
well, I'm gonna be bearish again this week.
Oh,
My
he's going bearish
expectations,
again. So we're on the
my
same side of the coin.
yeah, this time. So we either win or we lose together. My expectation is again was the same as last week. I think this war continues to intensify. I kind of underestimated market level delusion when it came to pseudo peace talks. I don't think there's going to be any declaration of victory if I don't think Trump is going to attempt to make a declaration of victory if the Hormuz is still closed, and I don't see any negotiations on the table. Who you're going to negotiate? Everybody's underground with no electronic communication to each other.
Yeah,
And then also, I've been hearing reports of Russian scientists being pulled from Iranian nuclear facilities. So that's a new front right there. If we start bombing their energy programs like that, next thing we could see probably tomorrow we see the desalinization plants bombed by Iran on the other side. So I expect again more rampant. I mean, we're talking about that. We closed off in an area the size of Ohio in Iran to hunt our guy down. So maybe that is grounds
When
for,
you
hey,
say that,
maybe
you mean to hunt the to try to find our pilot that was
yeah,
down?
yeah.
Yeah.
We shut down in Iran in an area the size of Ohio using our air force, and of reports of deploying special operation troops already on that ground level. So it is a this could be also proof that, hey, maybe we could just actually just march in there. Now, is that true? I don't know. I don't know if Trump will attempt that, but
I'll tell you
we'll
one
see.
thing. I wouldn't bet against our military conventionally. Losing an aircraft
It's the
is
best.
terrible, and losing a pilot is also terrible. But I still would not bet against
Oh yeah.
American just overall power. And whether Trump is right or wrong or smart or dumb, it's for somebody else to decide. I'm not really thrilled with what it's doing to our markets, and I'm certainly not also thrilled
Hmm.
about tariffs. But a couple of topics that we have coming up. We don't know when exactly we're going to do this because ARPA and I are still getting our hands around all this, but we're definitely going to talk about tariffs. In fact,
Yep.
I've got a media appearance later today with Spectrum News where I'll be covering the 1 year anniversary of Liberation Day. So you might want to check that out. Check out our YouTube channel where we'll be posting all of these podcasts that we do. You can go to Spotify, you can go to Apple Podcasts and download these. We would really love it if you liked it. We would love it if you shared your opinion on it, interact with us, tell us what you want us to talk about, and we'll talk about it. But we've got tariffs to talk about. I do want to cover with somebody as smart as you are, but I would really love to dive into national debt and the long term
Yeah.
implications of that. There's so many things that we'll have a chance to talk about doing this show weekly. And of course, we'll keep our running score so we can let everybody know which one of us two has got it going on the most. But I'm looking forward to coming back and seeing you next week. Thanks for joining me as always. We'll see you
Yep.
guys next week.
Thank y'all. Take care.